Joining us now on set is Phil Drury. He is the global head of tech and communications banking at Citi. Phil, are the private deals, are deals kind of gearing up again as the market has heated up again? I've started to hear some companies saying, okay, I see opportunity in AI, can't sit on my hands here, that will grow into the valuation that we have to pay.
Thanks, John. And Morgan, good to see you. There's certainly been a big impasse, right? It's been about 18 months. You look at M&A volumes year to date in tech, down 60%, so down more than the broader M&A market. That's been a confluence of reasons why, but one of them is a seller impasse. Just the rapid deterioration in public valuations, given the sharp rise in rates and the inflationary concerns. That impasse is definitely starting to thaw, obviously helped by the tech stock rally that we've seen year to date. And also don't forget the financing markets now are starting to, with sights on peak inflation and peak rates, and we forecast a 10-year below where we are actually today. As that thaws, we should start to see more deal activity, both M&A and also IPOs.
What's that conversation like behind the scenes? For example, IBM just did this deal, announced this deal, was it last week, week before? What's getting the companies and the lenders sort of off the dime and to do those deals?
I think just a greater sense of positivity on overall outlook. So consensus views are now softer landing in terms of the broader economy, likely to be the first quarter. We obviously don't have an immediate solution to what's happening in Ukraine and Russia. That can remain as an overhang. I think some thawing of tension, perhaps you could say, between the US and China. And we may even see some of these large cap tech deals. We may well talk about some of the guidelines with the FTC that have come out recently, but we might see some deals get over the line, and that should give some more confidence to deal activity as well.
So you expect that you could actually see some deals get over the line from a regulatory standpoint? Because I feel like I've had a number of conversations with bankers and the like where it seems like a lot of cold water has been thrown and splashed across sectors, across industries where so much M&A is concerned. Yeah,
no one's really wanting to call it. And I think we've got utmost respect for the regulatory bodies. But at the heart of M&A, the heart of what drives that corporate ambition, it's to improve performance and to fill gaps, right, in terms of the operating nature of the business. So a lot of respect for what the regulatory bodies are doing. Guidelines and clarity, I think, is very important. But there will undoubtedly be some confidence if we can get a couple of deals over the line. Also, if you just think about M&A and you look at financial sponsors and the amount of dry powder that they have at the moment, I think there's a potential to see more activity. In software, as an example, we think we've called peak consumption levels. And I think some of the sellers, Citi, we advised just last week on the Force Point deal in cybersecurity representing Francisco Partners. I think we'll start to see a little bit more of activity such as that.
Interesting. So it seems like there's almost three different buckets. There's M&A, there's IPO going public, and then there's raising capital in the private markets. I realize every situation, every company is different, but for some of these private companies and these startups that maybe have been kind of stuck in position for a while now, what are the most common conversations and what are people willing to do?
Well, when you want to look at appetite in the public markets, first thing you do is look at follow-on equity offerings. We've priced a number of follow-on equity offerings recently at pretty normalized discounts. The convertible bond market has been pretty active of late. Companies selling stocks at premiums with coupons inside of where they'll raise in the straight bullet debt market. So these are the types of signals that we show private companies who are potentially looking to go public to say, look, the market is much more investable than it was, right? You look at the VIX at 14 right now. You look at 85 basis points standard daily deviation. 12 months ago, that was a 2.5%, 250 basis point standard deviation. So the market definitely feels more investable today. That should give the confidence to potential issuers to come to market.